Italy's banks are at a crossroads.
With negative rates, different economic outlook, Brexit, the situation is all more complex and the urgency has just exploded. In Italy, there are more branches than pizzeria or pharmacy. And there are more employees and more branches per inhabitant anywhere else in the world. As a result, you need strong consolidation and a huge reduction in number of employees and branches.
But solving the problem is difficult. Italy is overbanked and its lenders are weakly profitable. Italy's banks also have €360 billion of soured loans, worth a fifth of GDP, built up during a decade of economic stagnation. €200 billion worth of these are the worst sort, non-performing loans. For some experts, the only way forward is to shut or restructure.
I think it will be difficult to escape this painful but necessary step if the situation of the Italian banking system is to be restored to soundness, and that's really important for Italian growth. One of the key reasons why Italian growth is so low and has been so low in the past few years is the bad shape of the banking system. So you need a consistent approach to get back to a sustainable growth track.
Shutting banks, though, is a political nightmare. Instead, Italy's Prime Minister Matteo Renzi, who faces a risky referendum on constitutional reform this autumn, has avoided several bank crises this year, using a privately backed fund called Atlas to buy shares and bad loans in problem banks. Investors, nonetheless, remain concerned.
I think the two main concerns are, one, regulatory risk, meaning the framework and the institutional mechanism are new and there is uncertainty around the way they're going to be implemented. And second, the stock of non-performing loans linked to the judiciary system. So basically the stock is one of the highest in the world. Second, this is not plain vanilla non-performing loan, real estate non-performing loans, but corporate SMEs. And third, our judicial system is overly bureaucratic and uneven across courts.
Investors are most urgently needed to pump €5 billion into Monte dei Paschi di Siena, the world's oldest bank and Italy's third largest by assets. Monte Paschi emerged the worst loser from European stress tests this summer, despite raising €12 billion since 2008. If the latest capital raising fails, European regulators could insist the bank is bailed in, which would mean investors and savers losing money. And Monte Paschi is not the only bank raising concern.
UniCredit, Italy's largest bank by assets and its only globally significant financial institution, came in with a core Tier 1 ratio of just 10.3% in June. Senior bankers say new chief executive Jean-Pierre Moustier will unveil a plan that will include a capital hike of up to €10 billion and sales of bad loans and assets later this year.
Amid this uncertainty, Mr Renzi has backtracked on promises to stand down if he loses this autumn's referendum. Senior bankers say this may help calm investor jitters. Still, Mr Renzi has not doused long-standing worries about Italy's economy, which showed no growth in the second quarter.
The Italian growth is certainly disappointing compared to the rest of the euro area. We have the same interest rate, the same exchange rate, the same oil prices, the same risks about Brexit and so forth. So really this suggests that the problems of the Italian economy are really still there. It will take longer to address them, and the reforms need to be probably much deeper than what the government has done so far. So the agenda, the reform agenda, has still a long way to go in Italy.
For Mr Renzi and the banks, the next months could prove decisive. This is Rachel Sanderson, Financial Times in Milan.